The US economy has been flying high recently. Near 1 million jobs were created in the month of March alone, and over the quarter as a whole, GDP grew at a 6.4% annualised pace, more than 3 times their potential or trend rate of growth. As good as the recent past has been, the immediate outlook is likely to be stronger still, with 1 million jobs per month and annualised GDP growth closer to 10% anticipated for the June quarter. By the end of June, the level of US GDP will be back above that seen pre-COVID. However, in stark contrast to Australia, the level of US employment will still be some 5 million below its prior peak and almost 10 million down from the level that would have been attained had the pandemic not occurred and the economy instead grown at its trend pace through 2020, 2021 and 2022. The intent behind this comparison of the recovery in GDP and employment is to highlight that while US momentum is at an unsustainable extreme currently, the economy will, indeed it has to, continue to improve for a long time to come to make use of its productive capacity, particularly its labour force. A key aspect of this improvement will be a broadening of the growth base. The initial recovery was highly concentrated in spending on durable items such as cars and household goods, as consumers isolated at home. The surge in goods consumption has continued in recent months, as the latest stimulus measures made previously unaffordable purchases possible for many middle and low-income households. But as the vaccine drive takes effect and risks related to COVID-19 dissipate in coming months, consumers will be able to move more freely in their communities once again. Services consumption will rebound strongly, benefiting all who earn their living from the sector. Residential construction also has a long growth runway. A similar point can be made for business investment. The investment undertaken over the past year has been heavily restricted to investment necessary to sustain business function through the pandemic. Victory over the virus will now progressively shift businesses' focus back to investment aimed at expanding capacity in the real world and online. It is only through this broadening of economic growth across the economy that capacity will expand, and through which all those who currently remain out of work will find employment opportunities commensurate with their skills. Clearly, this is as important for businesses looking to maximise profit as it is households trying to earn a good income. Without effective and efficient available labour and capital, supply constraints will develop, crimping activity gains and pressuring inflation higher. The FOMC clearly know this is the case. In their April post-meeting communications, Chair Powell made it very clear that as the risks from COVID-19 dissipate, the US economy must make the best of the momentum it currently has. Bolstering the supply of labour, goods and services through greater production will not create undesired inflation. Instead, it is when demand far exceeds supply that this becomes a risk. Hence, through the second half of 2021 and in 2022, the FOMC is set to maintain its extraordinary policy support in pursuit of the 10 million jobs likely still required by the end of 2022 to reclaim maximum employment and best support the welfare of the people. Only if inflation becomes an entrenched concern will it affect the policy stance, and then only if the risks around inflation outweigh those that would result from slowing or stalling gains in the labour market. We'll see you next time.